Northern Company, a manufacturer of infant furniture and carriages, is in the initial stage of preparing the annual budget for 2010. Scott Ford has recently joined the Northern accounting staff and is interested in learning as much as possible about the company budgeting process. During a recent lunch with Mark Atkins as a sales manager and Pete Granger as the production manager, Scott initiated the following conversation.
Good afternoon, Mr. Atkins and Mr. Granger. May I sit here?
Good afternoon, this is it. What's the matter?
Well, since I'm new around here and I'm going to be involved with the preparation of the annual budget, I would like to be interested in learning how the two of you, as myself and Mr. economics.
Well, we started very methodically by looking at our recent history, discussing what we know about the current accounts, the potential customers, and the general state of the customer spending. And then we add the base of intuition to come up with the best forecast we can.
So I usually take the projection as one of the projection, and of course I have to make an estimate for what volume control to be. It is something difficult.
Why does that present a problem? I mean, there must have been an estimate of total income showing the budget for the current year.
Those numbers are not always reliable since Mr. Atkins makes some adjustments before passing them on.
What kind of adjustment?
Like this. We don't want to fall short of the sales projection. So we give ourselves a little breathing room by lowering the sales projections anywhere from 5 to 10%.
So now you know why this year budgeted is not a reliable starting point. And of course we have to make a judge for projection for this rate as a progress of the year. And after that it will change the estimate of any inventory. And by the way, we also do the same thing for adjustment for the expenses. And I think everyone around this company will be right and the same thing as us we do.
Now we are going to have some comprehension from the dialogues we have heard above. So the first question is, Mark Atkins and Pete Granger have described the use of budgetary slack. For the A requirement, explain why Mark and Pete have in this manner and describe the benefits they expect to realize from the use of budgetary slack. So the answer is, the managers, which are Mark and Pete, decision to use the budgetary slack for the period may be caused by the bonuses and performance appraisals of the company or based on the targets achieved by them. They must expect some benefits such as they will be charged loss tax expense from the tax office. By stating the expense, they wish they could save the expenditure from the future years. The B question. Explain how the use of the budgetary slack can adversely affect Mark and Pete. The use of the budgetary slack can cause some effect to the company. It will decrease the performance of the company. It will spread ethical issues among the employees. And by lowering the revenue also can make the company lowering the expense from some vital part of the company. For the second question, as a management accountant, Scott Ford believes that the behavior described by Mark and Pete may be unethical and that they may have an obligation not to support this behavior. By citing the specific standards of competence, confidentiality, integrity, and/or objectivity from the standards of ethical conduct for management accountants in Chapter 1, explain why the use of budgetary slack may be unethical. The ethical conduct that is violated by the managers is the credibility, also known as objectivity. The use of the budgetary slack, regardless what the reasons are, cannot be acceptable in managerial concern. Great leaders must show good example to others. So that is some comprehension that we must understand from these dialogues. Thank you very much. Don't forget to like, share, comment, and you can subscribe. Thank you guys. Thank you very much.